Welcome to this week's Money Metals podcast, helping gold and silver investors during these treacherous times. Now, here's this week's market wrap with commentary and analysis from the company voted 2015's Precious Metals Dealer of the Year in the U.S., Money Metals Exchange.
This is Mike Gleason with Money Metals Exchange, and it is my privilege now to be joined by Gerald Celente, publisher of the renowned Trends Journal. Mr. Celente is a frequent and highly sought-after guest on news programs throughout the world and has been predicting the biggest and most important trends before they happen for more than 30 years now, and it's a real honor to have him on today, as it always is. Mr. Celente, welcome back, and thank you very much for joining us again.
Well, thanks so much for having me on, Mike.
Well, to start out here, Gerald, U.S.-Russian relations continue to deteriorate with conflict escalating in Syria most recently. Meanwhile, the Chinese, along with the rest of the BRIC nations, are in serious trouble economically. Pundits are starting to worry about a recession here in the U.S. Talk about the recent developments here and what you're looking for in the coming months from a broad perspective, given all the global geopolitical and economic turmoil that's brewing out there.
Well, let's stop on Syria just for a second. You know, I'm looking at this as a relatively positive development, and I'll tell you why. Obama met with Putin for 90 minutes this past Monday at the UN. And from all reports coming out of Russia, particularly from Putin, it was a very constructive meeting. They said they agreed on a lot of things. And here's the reality. The United States has not been able to make any headway in Syria. And I really believe that Russia's involvement is also being pushed by the Europeans, because you see the wave of refugees fleeing out of Syria, and they can't take any more. They don't want to take any more in Europe. They're coming out of Syria, they're coming out of Libya, they're coming out of Afghanistan, they're coming out of Iraq, they're coming out of Yemen, and of course they're coming out of African nations that are also being destabilized or going into poverty. So they can't take any more refugees in. I believe that what we're hearing now is face-saving for the United States coming through the media. That this terrible failure, what did they trade? You know the numbers. I'm not making this up. We the people spent $500 million to train a handful of so-called Syrian rebels, and now even that handful has collapsed, and they turned over the armaments that we gave them. So I believe that all this screaming about Russia is a face-saving operation, and that the United States is actually working with them to bring a serious solution. So overall, I think this is going to work out positive. On the economic front, I mean, let's look at the real numbers here. I mean, you saw, for example, one day the Nikkei goes down 4%, up next day 2%, on the good news that industrial production's down 0.5%. You know, how did this happen? Second month in a row. You look at the commodity prices. There was, on average, 1999 levels. You're looking at currencies hitting new lows and going lower. And then you have the fear of the United States raising interest rates, which means all those crashing currencies and all of those crashing commodities from those currency-rich nations and all that money they borrowed, they're going to have to pay it back with more money that they don't have. So, no, there's a global meltdown. But the geopolitics, I have to tell you, to me, this, and I just came up with this, by the way, within hours, that I believe there's going to be a serious solution, and I think Syria is going to be out of the news big time within a few weeks. That ain't good. It's just a guess. And by analyzing the information, I mean, I wouldn't call this one of my, solid trend forecasts, but I would say the trend line is moving in that direction.
Closer to home here, not much of a surprise, but the Fed decided to stick with 0% interest rates in their most recent FOMC meeting. It appears the market is damned if they do, meaning if they raise rates, it would be bad for asset prices, and also damned if they don't, because it would be a sign that the economy is too weak to even handle a slight interest rate increase. Now, correct me if I'm wrong here, but that doesn't sound like a very healthy economy. How do you see it?
Mike, tell me any time in history that we had a zero interest rate policy. Who made this stuff up? They've not raised interest rates since 2006, and zero interest rate policy has been in line since the end of 2008. Everybody now admits what we've been saying since they began doing it. It's a cover-up. It's not a recovery. The only people it's helped are the financial markets in the terms of the hedge funds and the high-frequency traders, mergers and acquisitions, and stock buybacks. End of story. They're in a trap. They don't know what to do. And the person actually that you really have to look back at is Greenspan, creating this bubble after the 1987 crash. A plunge protection team. Who made this stuff up? You calling it capitalism? The markets are supposed to rise and fall on their own merit. And they're supposed to be reflective of the conditions of the real economy, not speculators. And that bubble's been blowing up since. And now they have one that we've never seen in the history of the world, part one or part two. And again, go back to those emerging markets. You saw that IMF study that came out this week, where the borrowing has gone from 4 trillion to 18 trillion in 10 years or so, going to emerging markets, debt levels rather. So what we're looking at is that the bond market frenzy is about to explode. The stock markets can no longer sustain themselves without the cheap money. The paybacks are going to, you're seeing, the oil sector is in ruins in a lot of places around the world. So whether it's at home or around the world, no, there has been no cover-up. Here's a number for you. Median household income is where it is in 1989 in real dollars. So look at all the money we've lost.
What happens when all of this cheap money has to be paid back, or when the game stops and there's no longer loose monetary policy allowing these players to borrow at low rates and reinvest in higher yielding assets? What happens when that finally does happen?
You have a crash. You have a global crash, which we think is going to happen before the end of the year. It's going to be a worldwide equity meltdown. And that's why even though gold it's not shining, it's certainly not doing what iron ore or copper or a lot of these other metals are doing, because it's a metal in all of its own. It shouldn't be lumped in with the other commodities. Nobody pays me to say that. We have no advertisers, I'm saying what I believe. I don't give financial advice. I put my money where my mouth is. Gold is the ultimate safe haven, and it's going to remain like that. It's been like that since the written word was first written, and it's not going to go away because some speculators say it's going to go away. So all of this cheap money is going to come at a price, and the price is devaluated currencies. Look, all right, here. Let's pretend that we're going to change the name, your last name. We'll make it a Portuguese Brazilian name, and you're from Brazil, Pedro. And your real just lost 40% in a year. You wish you had gold? If you're living in Turkey, if you're living in Indonesia, Malaysia, and you're watching your currency crash to new levels, you think you wish you had gold? So that's what we're talking about, but that's not making the news. The only reason the dollar is strong is because the other currencies are so weak.
Do you ever see Yellen and company raising rates there at the Fed? Of course, they've been talking about that for months. Are we finally going to get an interest rate hike?
I think they're going to have an interest rate hike. They have to. And I think it's only going to go up about 25 basis points. Even if it went up 50, so what? From near zero, that's not a lot. But what it's going to do is going to rattle those emerging markets. That's why they can't do it. That's the big one, because they got all that hot money. It's not only it's mutual funds; it's a lot of them that invested in these foreign countries, and now with their commodity prices crashing and their currencies crashing, interest rates go up. The crash gets louder and spreads wider. So they're in a trap. And matter of fact, you mentioned that the FOMC, Open Market Committee, said they were holding rates back in mid-September. And then just a week later, Janet Yellen at the University of Massachusetts couldn't even finish the sentence. She started coughing it out, that they intend to raise rates. And they took her off the stage. And she ended her talk. So I think it was, I think she was really, I think literally she was choking. And that's what they're doing. They're choking. They don't know what to do. But they're going to have to raise them.
What do you make of the metals markets? We're seeing firsthand a massive disconnect between the physical markets and the paper markets. Demand for physical bullion is just overwhelming mints and refineries, while traders apparently can't sell gold and silver fast enough in the futures markets. What are your thoughts about how the metals markets are working?
Look at the reports coming out in the last few weeks. What a surprise. The Germans and the Swiss are looking into manipulation of the metals markets. It's not in the interest of any central bank to see gold and silver prices go up. None. Because that shows the worthless value of their digital dollars, yuan and yen, backed by nothing and printed on nothing. We know they rigged the LIBOR rates, the interest rates. We know they rigged the Forex markets, the currency markets. That's not speculation. It's not conspiracy. They were charged, convicted of felonies. But, of course, no head goes to jail because, hey, they're the white shoe boys on Wall Street. They're better than the rest of us. So they can commit the kind of crimes they want at any level. So, of course, they're rigging the bullion markets. There's absolutely no doubt about it. Look, here, I'll give you an example. If you go back a few months ago, the Japanese markets were closed. The Shanghai market, 9 o'clock in the morning, they usually trade about 13 to 16 tons of gold. All of a sudden, 33 tons were shorted within 2 minutes. And that brought gold down to where the level it is now, where 33 tons were traded that day. Within 2 minutes, most of the trades went through. So they're rigging it in front of our eyes. It was right there for everybody to watch. This is Shanghai market.
You touched on it there a moment ago, but gold is maybe struggling in dollar terms, but it's doing quite well in these other currencies, and obviously they're seeking refuge in that as their currencies are continuing to devalue. Now, I know you can't give financial advice, but what do you have to say to investors here in the U.S. who may be lulled into thinking that gold and silver are never going to go up, but they're also concerned and want to be ready for what they see coming?
Well, again, if they're concerned about what's coming on, how could you not want to have gold? And why would you want to have any of these paper? Look at the Fed's balance sheet. Where'd it go from 500 billion? They added 3.5 trillion onto it. In a couple of years. Look at the debt of the United States that nobody talks about. Look at the debt to GDP ratios in China and Japan, Italy. Look around the world. To me, again, the motto of the Trends Journal: think for yourself. Why would you not want to hold gold? By the way, I believe in silver as well, but I'm more bullish on gold because silver is still used in production purposes. However, having said that, when the currencies are devalued, as you're going to keep seeing more and more of, gold and silver are going to be worth more. So here's what I always say. Plan for the worst. If the worst doesn't happen, you've lost nothing. If you don't plan for the worst and the worst happens, you lose everything, or a lot of things. For example, let us suppose that there's some kind of geopolitical event that we'll call a terror strike, false flag or real. Remember what happened when 9/11 went down? Wall Street was closed for a week. I had money in CDs I wanted to get out. I couldn't get them out. CDs, they told me, I traded on Wall Street. That's when you used to have a thing called interest rates. You could make money with CDs. It's like ancient history. Anyway, if you don't have it in your pocket, you don't own it. They could call a bank holiday at any time. You just saw it in Greece. A couple of years ago, we saw it in Cyprus. If there's a economic meltdown, what's holding up the Shanghai market other than it being rigged every day? You look at the end of the day in the Shanghai market and you see it shooting back up in the last hour. The national team, they call it, comes in and tries to resurrect it. You look what's going on with the volatility in the markets continually, whether it's in currencies, commodities, or equities. you see the volatility in front of you. This is not a calm time, and there's nothing to look back on or coming ahead that says the fundamentals of the economy are sound. There's nothing there. Retail sales are soft. Job creation, yeah, they're creating jobs that pay nothing. Student debt is bigger than credit card debt. Why? Why would people think it's going to get better when the data qualitatively and quantitatively adds up to more of the same but worse?
Well, Mr. Celente, I want to thank you very much for joining us, and it's always great to talk to you. And before we let you go, we definitely want you to tell folks about the tremendous information you put out, both online and with your extremely high quality and extensive Trends Journal magazine. I understand the fall copy of that will be coming out before long, and then also any other information that's going on there at the Trends Research Institute that people should know about.
Well, we just had a great conference here. Dr. Paul Craig Roberts was here, among others. And he never travels anywhere. So we have conferences. We're going to have another one coming up in December. You can go to our webpage, trendsresearch.com, and sign up now before it's too late. We'll be releasing the top trends of 2016 plus more. And also, of course, the Trends Journal, which is the quarterly. We just sent out the Trends Monthly yesterday. And we also have Trends This Week. We send out a hot trend each week mostly on markets and geopolitics. And each weekday night, we do Trends in the News broadcasts every Monday through Friday. So it's really the only place where you're going to see history before it happens. And I encourage everyone to consider signing up. If you don't like it, there's that 30-day money-back guarantee. So it costs you nothing to learn.
Well, it's great stuff as always. Definitely urge people to check that out. And Mr. Celente, thanks so much again, and look forward to talking to you again down the road. Have a great weekend.
Hey, thank you so much, Mike. Always great being on with you. All the best.
Well, that will do it for this week. Our sincere thanks again to Gerald Celente for his fantastic insights. For more information, the website again is trendsresearch.com. Tune in next Friday for next weekly Market Wrap podcast. Until then, this has been Mike Leeson with Money Metals Exchange. Thanks for listening, and have a great weekend, everybody.
Thank you for joining us for this week's Money Metals podcast. Be sure to come back next week. And don't forget to subscribe to our podcast through iTunes for answers to all of your questions, or to discreetly and securely buy or sell gold or silver coins, bars, and rounds. Call 1-800-800-1865 or visit www.moneymetals.com. Our knowledgeable and no-pressure specialists are standing by between 7 a.m. and 5:30 p.m. Mountain Time, Monday through Friday. Or you can lock in your order online, 24 hours a day, 7 days a week. Again, visit us at www.moneymetals.com or call 1-800-800-1865.